Deep value stocks are a once in a lifetime opportunity where you find a stock that has huge upside, minimal downside, and other investors are ignoring. Today, I think I found what is the most obvious deep value stock in Canada. It's Tourmaline Oil. This Canadian natural gas producer has been the talk of the town, and yet the price has not moved at all. With all of this massive bullishness, you should see the stock price running, but it isn't. Instead, we see that the opportunity to buy the stock is still there today. There is still significant undervaluation on an objective basis, and the bull thesis continues to get stronger. So I'm going to talk today about why I think Tourmaline Oil is such a great deep value opportunity, why I am buying the stock in December of 2025, and why I think if you're willing to hold for the next 5 years, this is probably one of the best names to be on your watch list in the Canadian energy space. We're going to start with this article by IWA Research. They did a fantastic job breaking down some of the numbers here, and I really love their work, so I love to feature them whenever I can. Now, these guys have talked about Tourmaline a couple times before, and the article starts off by saying a lot of the things that we here on the channel have talked about plenty of times. Tourmaline has a lot of power coming as the strategic expansion into LNG-focused infrastructure comes online, as the production growth that they've seen over the last little while comes online, as a lot of capex over the last couple of years to build out for this LNG boom comes online. There's a lot of these stories happening at the same time. However, we also saw that there were some short-term headwinds. Natural gas pricing in Canada was way lower than expected over the last 2 quarters. Saw a lot of these companies sort of slashing budgets, cutting capex. A lot of folks were quite afraid. Now, Tourmaline didn't really do that. Instead, they continued to build in some flexibility, but they also continued to produce at higher levels, and they talked about plans to expand even more into their BC Montney. And to do that, they're going to sell off their Peace River High assets, which would basically mean they're selling off assets right now, taking that cash, investing it into the BC Montney, which means that they would be sort of sacrificing short-term for long-term. And I think that's probably the best way to describe their 2025. The start of 25, everybody expected these guys to have a killer year. They said, listen, there's some of these challenges operationally. We're going to have to sacrifice some of those stock price gains in 25, and then you're going to see that massively compounded in 26, 27, 28, 29, and beyond. And that story really appealed to a lot of investors, including me. But what it didn't appeal to was the overall market, because people weren't willing to buy or put their money into something that they knew wasn't going to run up a huge amount, even while the rest of the market did. And so while names like Peyto, who offered a lot better short-term results, all had huge years, Tourmaline didn't. Tourmaline barely moved at all. Now, there's also some significant long-term gains to be had in basically any energy name in Canada. There's been a huge change in the zeitgeist around energy, of course, but still, with Tourmaline barely moving, it makes me even more excited to be buying today because I've had the opportunity to accumulate shares over time, meaning my overall cost basis is going to be better than if I was going to wait another 6 months and gamble on whether or not the stock would stay down. Now, as I go through the article, there's a lot of strong things to point out. They talk about the fact that the company was rated a strong buy recently. They show off some of the most recent earnings report from Q3 25, and they show the growth plan. Now, this is, of course, from that same report. And you see production basically in 2026, we're seeing 690. You see a modest growth over the next couple of years, followed by a little bit more significant growth. And so you're growing at a pretty significant rate. You're looking at the base dividend staying basically flat. You're looking at free cash flow growing significantly in 2028. There's going to be a huge amount, which is obviously an awesome thing for those of us looking for a total return with some dividends in there. And there's a lot of positivity in getting rid of the debt on the balance sheet. So a lot of good things. However, a lot of that is asking you to wait a couple of years. Again, not something that many investors are really willing to do in this market. A lot of people are chasing that short-term high. They don't want to sit and wait for a couple of years when they think they could just make their money now and get out. Now, as we continue through, there's a lot of other very interesting things, and I recommend you read the article. They talk about the macro with the interest rates dropping in the United States. Obviously, they talk about the price of natural gas going on an absolute tear. If you haven't looked at it recently, we saw it hit as high as $5.50 midday Friday, which is huge because $5.50, again, that puts us in company we haven't seen since 2022 at that point. And that huge pricing does mean some significant things. It means obviously AECO pricing, which was sitting at about $3, that's grown significantly. There's still a significant differential there that is basically the cost of transporting Canadian natural gas down to the United States. But still, there's a significant boost in AECO pricing. It should get even better as we see LNG Canada Train 2, so the second half of the first phase coming online, and a lot of other positive momentum, including things like new AI data centers and new rules around building out natural gas power in Canada being sort of incentivized, right? So a lot of things have changed. There's a huge bullish story in AECO, but also the natural gas price itself is booming. And if you think about every other commodity that's boomed in 2025, you would expect to see stock prices running. Again, Tourmaline isn't, because they're still investing a significant amount of capital right now. They're willing to sort of forego this short-term sugar high in order to build a stronger business long-term, something that I think presents a real opportunity for myself as an investor, because I'm not looking for the next 6 months of gains, right? I'm not a swing trader here that's just trying to make a quick buck. I'm looking for really high quality companies that play interesting macro trends in the long run. Tourmaline fits that bill, in my opinion. Obviously, natural gas has been huge. Natural gas demand is ramping, but also, of course, liquefied natural gas exports are ramping. We saw the United States has become the largest LNG exporter and continues to massively ramp the demand. So the actual LNG that's getting shipped from the United States, that continues to ramp massively, and it's going to ramp through the end of the decade. There's some folks who would argue that maybe that presents a challenge for liquefied natural gas. Maybe that would present some sort of pricing decrease on natural gas overall as more liquefied natural gas becomes available and it becomes less sort of expensive for the European or Asian markets. But I also think there's a huge story to be built around if that price decreases, all of a sudden you're creating more demand, because obviously the best challenge there would be to drop the price. All of a sudden it's much more affordable. A lot more countries can get in. So there's a whole story, and overall the bullishness is definitely there. Now, when we talk about the marketing of the next couple of years, you see there's going to be continued exposure and growing exposure to AECO pricing, even though there's a significant amount of that pricing currently hedged. You see they're continuing to keep a lot of strong US Gulf. We're seeing Empress pricing. Obviously, we're seeing a significant amount of things like, US Midwest that they're cutting out a little bit. You're seeing NYMEX basis, right? There's a lot of marketing being done by the company to achieve a higher realized price short term. I don't know how that's necessarily going to play into the next couple of years. You're looking at maybe about half and half between their hedged slash marketed pricing and their AECO pricing. But I think that AECO is going to meaningfully, and I mean meaningfully, cut that differential with NYMEX pricing over the next couple of years as we see more demand coming to the basin here, as we see more infrastructure built out. So I think that there's a huge bullish story in both halves of the business. And if one underperforms the other, then having this significant diversification puts them in the driver's seat. And I think that's huge. As we go down, this is my favorite part of this whole article, because really interesting elements here. If you look at some of the assumptions about free cash flow that we saw in that earlier chart where Tourmaline outlined what exactly they were investing in, you see some solid numbers. 25, we're looking at 550, 26, 650, 27, 650, 28, 1.5 billion. And then following that, they're looking at a 4% compound annual growth rate of free cash flow, which is significant, because if you think about the way that you would probably want something like a dividend to grow over time, having a 4% free cash flow growth would be significant. And obviously there's a huge amount of free cash flow growth between now and then. So you're seeing compounding on top of an already much higher number than today. You're seeing a significant terminal growth rate. That 2.5%, that's nothing to sneeze at. You're seeing net debt going down. You're seeing shares outstanding at 386 million, and that puts the enterprise value of the company at $24.88 billion. Equity value is 23.61, which means that there's an intrinsic value per share right now of $61.01 American, or $85.26 Canadian. That is a significant leap from the current share price. And remember, that is the intrinsic value of the company. That is not what you should be paying. That is what the company is worth. So right now, you can go on the TSX and buy for an almost $20 discount a company with significant long-term natural gas growth, that is exposed to not only the AI story, but also is exposed to the LNG story, is exposed to gigantic amounts of demand growth, is exposed to the decline of US shale, which, if nothing else, should be the most exciting long-term thought about this company. For me as a long-term investor, I look at US shale counts continuing to decline. I look at lots of short-term gas and then lots of long-term problems for US shale producers. And I look at the fact that US money is already looking to invest in the Montney, with Ovintiv obviously sort of changing track after originally coming from Calgary down to Denver, now going back up here and investing in the Montney. So you see American companies are noticing significant amounts of investment into the Montney Basin because it is the younger of the shale basins. It has a significant amount of long-term resource. And you see a company like Tourmaline, who has put themselves in prime position to supply long-term contracts. So you have tens of billions of dollars, if not hundreds, investing into new natural gas demand at a time when you can buy a natural gas company producer in one of the best plays on the planet for a $20 discount. Make that make sense to me. It just does not play out. And the thing is, we have told this story before. This is not the first time on the channel that we have looked at Tourmaline and said this doesn't make sense. But the market is still so focused on the short term. I am not saying that any investor should go out there and put 100% of their portfolio in a company like this. Of course not. I'm not even saying that you should make it the entirety of your energy position in your portfolio. That's not how I invest. I don't think anyone should invest like that. But I do think that if you are trying to build a long-term compounder in the energy space, this is such an obvious pick that it shocks me when I go on Twitter and I see people still fighting over whether they should own Peyto or Tourmaline. If one of them is giving you great short-term returns and one of them is offering fantastic long-term returns, why not just own both? If one of them is offering you a more aligned with your time basis, is offering you something that's closer to what you're trying to invest for, then pick that one. But for me, I want to be exposed to this short-term boom in natural gas prices. Sure, I would love for my portfolio to jump 50% in a year. Who wouldn't? But I also am a long-term investor, and I understand the power of compounding. And I understand that even if investing in the long term is unpopular today, it sure will be popular in 5 years and even more popular in 10. And when I look at a company like Tourmaline that is trading for a discount to intrinsic value at the same time as we are in one of the most expensive stock markets that I can remember, all I see is opportunity. So I'm buying the stock. And while lots of people are going to say, listen, we've told the story before, I own a little bit, but I'm not sure. Maybe I own one of the other natural gas players. That's okay. But I think the long-term potential here is gigantic. I think the ability for this company to outperform the resource is huge. And I think the fact that they are simply playing the long-term trend instead of gambling on short-term commodity pricing makes it so much more attractive for me as a longer-term investor, even in the energy space, where obviously there are lots and lots of volatility questions and geopolitical questions and technology-driven questions. I think this company offers so much opportunity at the same time as it's trading at such a discount that I just have been buying so many shares. And I really did want to tell that story because so often people ask, what is a company like this worth? How do you figure it out? And there are a million different ways to look at it. But I think if you simply discount the cash flows and you take a look at the way the company should be valued, and you see these kind of dramatic swings where a company like Tourmaline has had a stinker of a year, has had a tough 25. The stock chart has been basically flat with small variations the whole year. It just makes sense because nowadays that company is undervalued. It's even cheaper today than it was 6 months ago when this story wasn't as developed, or 6 months before that when the story wasn't as developed. So I am buying as many shares as I can get my hands on. And I really recommend that folks take a look. I'm not saying it's necessarily the stock for you. And I'm not saying that I should be the one you listen to for investments. But if you are looking at Canadian energy, Tourmaline Oil is a great opportunity to check out. And I think it really does deserve a spot. So if you have another stock in the Canadian energy space that you want a bit of a deep dive, you want to talk about intrinsic value, you want to talk about what the company should be worth today, you want to talk about the bull thesis, please do let me know in the comments down below. As always, if you like this video, you made it this far, please do like it. If you like the channel, you like covering these Canadian topics, please do subscribe. And I hope I see you in the next one.